welcome to another edition of the Energy Week podcast. Ryan Ray alongside the one and only Dr. Energy herself, Ellen Wald. Ellen, how's it going?
We are doing great. Thank you.
We are doing great. The Warriors, since we last spoke, fell down and did not win. Have you ever seen a team have more injuries than what they had?
Every time I wanted to feel bad for them, I remembered the year that the Celtics made it to the finals and Kevin Garnett was out, and then Kendrick Perkins was taken out, and I just then had no sympathy.
Yeah, Perkins blew out his ACL in Game 6, I think, and Meta World Peace.
Oh my God, I remember that.
That was fun.
Was it the same series when Rondo had his elbow dislocated or something and then came back in the
maybe, I don't know. It's that one does, but maybe so. Anyways, we got a lot to get to today. Since we last spoke, Ellen, there has been a little bit of news going around internationally. Not a lot. It's kind of been a quiet news week, but
oh yeah, for sure. Just some tankers blown up in the Middle East.
Well, I saw the initial reports, kind of cracked me up. I saw the initial reports where torpedoes were involved, and I thought, okay, if torpedoes are involved, this is going to get pretty bad pretty quickly because, not everyone just carries around torpedoes. And I'm not a torpedo expert, but I would imagine torpedoes are kind of like bombs. They kind of have some characteristics that are unique depending on where they come from and how they explode and things like that. So I think they're saying now it's a mine officially, though. Is that the latest word?
Some kind of magnetic mine. Here's actually something that's very interesting that has not been really talked about very much, but they're saying it was these magnetic mines, the same ones that they used on the tanker sabotage attacks a month ago. But some people are saying that they were attached when these ships were at port, as opposed to being attached at another time. I don't know exactly how this whole magnetic mine attachment thing works, but that could be an interesting issue, particularly in terms of who did it and how to stop this.
So I don't know much about the magnetic mines either, except for I had a client who is from Italy, and after World War II, that was his job. He was in a mining boat, and it was a wooden boat, and they would sail around and they'd go and find the mines, and then I think they'd pull them out the water, or disable them in the water, or blow them up, or whatever they do. But that was his whole deal, and so they were in a wooden boat, and they would go around and find the mines. So that's about my extent with the.
I can imagine doing that in a wooden boat because apparently, according to people who know stuff about ships, so all these tankers have double hulls. Mm-hmm. So when the mines blew up, they only damaged the first hull and not the inner hull. But could you imagine doing that in a wooden boat?
Well, that's the thing, though. It doesn't go off on a wooden boat.
Oh, because it only goes. Oh, yeah, but still, what if it accidentally goes off and you're next door? Then you've got splinters everywhere.
I agree. When he told me that, I'm like, I don't know if I'd want that job because it wasn't a big deal. It's a wooden boat. And I'm like, yeah, but there's metal somewhere in the boat, surely. So, But anyway, so let's talk to our first article, or go to our first article rather, from CNBC. Saudi seeks oil supply protection as U.S. and Iran face off. Trump says U.S. video shows Iran did it. Undisputed. They are the culprits, guilty. The Saudis are looking for some relief here, potentially? Protection?
I think what exactly are they looking for? I mean, I don't think that it is hands down assured that we know that Iran did it. I'm not as convinced of this supposed proof as, everyone else is, but, I don't get the presidential briefings, that's, secure briefings. So maybe they know stuff we don't and just don't want to say it. But anyway, say they are. Okay. And obviously Saudi Arabia is they did it. They want their tank cured. What is this? The U.S. is supposed to be the traffic police in the Persian Gulf? I mean, I don't know. I know that that's historically the role that we've taken on in the Persian Gulf, and we have our ships there and our Fifth Fleet, and we can be there to assure that nobody closes the Straits of Hormuz. I think it's questionable whether Iran actually could pull that off if they tried to. I'm not convinced that they have the ability to do that, but say the U.S. is there to do that, but are we really there to like escort tankers in and out? Are we really there to like keep an eye on all these little boats that go buzzing around, apparently putting magnetic mines on ships? I don't know. I just think it's worth asking the question, like, is this really our role? No U.S. ships have been attacked. The U.S. is not necessarily dependent on, are we even getting a whole lot of oil that comes out of the Persian Gulf? I haven't looked at the recent stats for where the U.S. is getting its oil imports from, but do we really need it? If I know we do import some Saudi oil, but that could come from the Red Sea, not the Persian Gulf. How about Japan and Norway and the other places that are having their tankers attacked? Maybe they should step up a little. I don't know.
Yeah, well, I know, and it's, I hate to put my Alex Jones tinfoil hat on here, but it's funny.
Well, I'm a right-wing propagandist, so everything you just heard was clearly pure right-wing propaganda.
Exactly. What's frustrating to me is the U.S. set themselves up almost to have to take this stance. If you remember, we talked about it on the show a few weeks ago. Pompeo come out and said, "Hey, if anyone who does anything with our friends and friends of friends and their friends and our enemies and their enemy, basically." The slightest thing fell under what he'd laid out, and now you do have something, and that is a legitimate attack. Obviously, I don't think that's. There's a ship that's on fire. We know that. We all agree on that. What happened? How it got there? All that stuff. I have no idea. But the U.S. put itself in a position that it has to respond at a certain level, and I think that's kind of the bad thing because. There's political pressure on the U.S. side of things that said, well, you basically called them out, and now here it's going. As you mentioned, we're not getting the presidential briefs anymore. I don't know, Nate, what happened to those. Get back on those. We need the morning CIA briefings. But, I think I said on the show 3 or 4 weeks ago, something like this could happen, and what are they going to do? And then now here they are. When you draw the lines in the sand, this is kind of where you put yourself, is that you have to respond accordingly. And as you said, is it even the U.S.'s job? Which I think is a very fair question to ask, and one we should probably ask more often, because it seems like a lot of this stuff is very convoluted on whether or not it's actually even best use of our tax dollars and our military resources to go and be involved with this stuff.
One of the other interesting things that to observe about this whole situation, and I'm going to take off my Rand Paul hat now because that was clearly a Rand Paul rant before. One of the things that I found was most interesting about watching this unfold in the morning was that first the report was oil prices jumped 4%. Okay, well, the previous day on Thursday, they dropped 4% because the EIA reported a build. So, when you're reporting that, you're like, they jumped 4% on this. So they basically just erased all the losses from the day before. And then as the day went on, they kept changing the headline. So it was 4%, then it was 2%, then it was 2%. Apparently it settled at 3.4% or something. But, oil prices are not being affected here. I mean, that's almost insane. That's almost a story in and of itself, is how focused everyone is on this demand picture and the fact that the U.S. is producing, I think according to the API report, 12.2 million barrels per day, such that no one really cares that, someone is exploding tankers in the Persian Gulf. Now, there is the fact that these tankers were not actually carrying crude oil. They were carrying products, I think methanol and naphtha, but still could be an oil tanker.
No, I agree, and I think there was a note that you were sending back and forth about someone speculating on what the price of oil would be if
well, that's our next. Yeah,
I know we're getting that here in a minute, but and we were talking about this on the Textile Gas podcast this morning. There is some fear that the oil and gas industry, could be in somewhat of trouble if you look at that because of all these things. And it's like, man, the price should get higher, and it's not. Obviously, the trade war is going on with President Trump and everyone including the great nation of Antarctica. It seems like we got we got tariffs on every nation, continent, province,
Those
state,
penguins.
county.
Those
Penguins, yeah, those
penguins.
penguins aren't producing enough. It seems like there's something going on there, but it's really baffling because how much do you think just on the tariff stuff in general are the traders actually worried about the trade war versus how much do you think the traders are feeling, you know what, if we can keep prices down, once the tariffs are lifted, assuming they are, prices will then shoot up and then that's where we can make some money. So do you think it's
Wow. Now that is a theory. So this is almost like a combined market manipulation. They're basically waiting it out and then they're going to ride this huge jump out. I wouldn't be surprised
yes.
because but look at all, I think that's what a lot of these analysts at banks are saying.
Mm-hmm.
Remember, I think a couple weeks ago, we did an article where we talked about how, I don't know, maybe I wrote about this. Maybe we didn't talk about it. Maybe I wrote about it at investing.com. It's one or the other. Could be both. Where we talk about all these analysts are keeping their forecasts for the rest of their average price for Brent for the rest of 2019, and they're keeping it steady, and which means that they really anticipate that the price is going to jump a lot more. So maybe they're banking on Trump getting this trade war thing being resolved, and then we're going to see a big jump. And
Well, you kind of
are using that.
And also, is if it doesn't work out with the tariffs and you've kept prices low, then you've kind of minimized the loss on that side as well because you've kept everything within check. So I don't know. It's always hard to figure out exactly what the market's thinking and why it's doing stuff. But you would feel. I mean, I think I checked WTI this morning. It was at 52. It just feels like, man, we got ships getting blown up and threats of war, and the price isn't even bumping. Okay, here's the piece I referenced from Platts. According to an interview, abundant oil supply prevented spike to $140 a barrel after ship attacks, according to a U.S. Department of Energy deputy, and that is Deputy Energy Secretary Dan. Cannot say that last name. Bruletti,
Don't look at me. I took Spanish. Did not take French. Sorry.
The article will be linked in the show notes, so you can. I can't even say Iran right, so we're not getting this. So 140. It sounds crazy when you hear that headline. It does sound crazy, but we have seen prices spike dramatically over wartime type actions, or prelude to war type actions that are from the economy. And now that's been maybe 15, 20 years ago, but historically, to see a significant spike in oil prices like that is not a crazy thing to think. It's just crazy to think it today. It seems like.
I know when WTI is 50, it's really hard to think about it being 120. But the more I think about it, maybe I wouldn't have said 120. I might have said 100. Because it's not just U.S. It's not just robust production from the U.S. that's keeping prices down. It's we're not the only big producer out there. So you say the U.S. was not producing 12, but we were producing 8 or 7 million barrels per day. I mean, we'd probably already have higher prices because of the sanctions and whatnot. But things we have to go, like if we I hate these counterfactual things, like when everyone's like, well, what if, Hitler hadn't been killed, then what would the world look like? It's like you have to go back so many things. So like you have to go back, okay, so say we're not producing that much or something happens to like stall production, then Venezuela doesn't crash and this and this and this. And it's like so many things are different. You can't really even have a recognizable future. And my brain wants to hurt. So, but so I don't know. I do think that $140 a barrel makes headlines. So, maybe, that's, you say something like that. Maybe if U.S. production was 0 instead of, it's so hard to imagine that, but you're right that normally these kinds of events, or even just the thought of an event like this, the geopolitical pressure pushes prices up. And now I'm looking at this article more carefully. There's actually a really interesting tidbit in the end that has nothing to do with any of this, but just seems like it was stuck in there. It's the U.S. Energy Secretary Rick Perry met last week with the Polish president. Remember, the Polish president and his wife were visiting the White House last week. I can't pronounce his first name, Andrzej Duda. last name, Polish president, they met last week at Cheniere's Sabine Pass LNG terminal near the Texas-Louisiana border. And I think that's significant because, without this resolution to the trade issue with China, a lot of U.S. LNG, they're kind of waiting, like they're waiting. They need these contracts with China to really get things going. And China was seen as a big customer for U.S. LNG, but Poland is too. And Poland is stuck with Russian gas right now, and they would like to get options. They'd like to diversify. And look, if Rick Perry is bringing the Polish president to visit a U.S. LNG facility, I think that bodes well for the future of U.S. LNG that's not necessarily reliant on China and the China trade talks.
Yeah. And one quick thing, just to circle back around to the pricing thing you mentioned a minute ago, I do think you're probably right. I think the 140 is more representative of the price. The number was going to go really high, because if you said the price would spike to 80, that probably doesn't make a lot of headlines, even though that might actually theoretically be the number is. So the 140 probably is more of representative of oil prices that would have gone berserk. So I think you're probably right there. Sometimes I think we've lost the ability to read things in the spirit. It's just all literal. Everything's literal, and of course, if you follow President Trump by now, you should learn that you cannot hardly ever read him literally.
Oh no.
Of course, that's right-wing propaganda. So anyways, okay, final article. We have Dr. Foreman coming on here in just a few minutes. So let's go to Reuters real quick. Iran, Russia talks end without deal on OPEC Plus meeting date. I know David Blackman had a piece about that this morning in Forbes. Obviously, you're following this very closely. Ellen, are they waiting on you to officially announce that you're coming? What is the holdup here to get this deal done?
Yeah, I'm more chill about this, but you should see the reporters are having conniptions, because a lot of them have plans, like vacation plans in July, like a lot of people do. Personally, I think that the issue here is that Iran's oil minister has been invited to a really big 4th of July barbecue bash that he doesn't want to miss. And so that's why he doesn't want to move the meeting to July 3rd or 4th.
Because nothing says Iran like 4th of July.
Well, yeah, it's either a barbecue or it's like one of those big protests where they say "Death to America," and
Well, you could have a barbecue and burn a flag at the same deal. That's possible.
Yeah, hey, in America, totally cool. Personally, I wouldn't try that in my neighborhood because you might get some really angry folk. But if that's how they celebrate in Iran, they're also doing it at the U.S. Embassy.
At the U.S. Embassy, absolutely.
No, okay. Jokes all aside. So this scheduling conflict is kind of a microcosm of the larger issue in OPEC, which is, in my opinion, that Al-Faleh has really gotten himself into a corner. He's in a pickle, basically, because he's let Russia be the determining factor in all of this. And so they want to move the whole reason to move the meeting from the beginning of June was because of Russia in the first place. And Russia's like, no, we can't go. I'm busy. I don't know what he's busy doing. Maybe he is doing prep work for the G20, or he's at the G20, or God only knows what Novak's doing. I don't know, some other cookout that Zanganeh wasn't invited to. But anyway, so Novak can't go. So that's why they wanted to move this meeting to July 3rd and 4th, to have the OPEC and then the non-OPEC and then the OPEC plus the next day. And Iran's like, no, sorry, I have planned. I can't go then. And the issue is, in terms of the OPEC bylaws, is that Iran can basically say that and they can't move the meeting because they all have to agree. And so Novak went to Tehran today to meet with Zanganeh. And the outcome was well, we could have the meetings separately. We can meet, OPEC can meet in June, and then OPEC Plus can meet the next week in July. Or he proposed a new date of July, 10th through 12th. It's can't they just have your people call my people, or send out a Gmail calendar invite, and everyone, this is getting ridiculous. But it's a sign that that Iran wants to cause trouble. It can cause trouble. It's in a position to cause trouble over this, even if, Iran is exempt from this agreement. It's not exporting that much oil, although hopefully soon we'll have some really good stats on exactly what kind of oil, how much oil Iran is actually exporting. But, you know, if everyone thought that Novak could work some kind of like therapist magic, no, apparently he didn't. And someone's going to have to give.
Right. So, a couple things on that. First off, a lot of these things that you're mentioning here, they are international events. It's not like, if I called up Ellen, I'm like, hey, we're going to go, could we come to a meeting? And obviously I don't have access to your calendar. You have access to my calendar. We're trying to work it out. And then we've got all of these forces that we're trying to deal with. This is, G20 is something that everyone can look up. So you have to presume here that there's some posturing that's going on. It feels like Iran might be the one posturing. They're probably hurt. Their feelings hurt the most out of this. But also Russia has felt the pressure, probably internationally some, with the crude oil pipeline that was contaminated. So, like you say, it feels like you can just send a WhatsApp over to get this done, but they can't. What other larger issues do you think are at play here outside of just the calendar request dates?
Well, I think that part of it has to do with, are they going to roll over this production restraint deal? And it seems like they are prepared to roll it over, but I think Iran is really upset about the degree to which OPEC has basically deferred to Russia, and Russia's not even in OPEC. And I think that's a large part of it. And this was brought up in a smaller way at the previous OPEC meeting, but I think it's really coming to the fore here is that OPEC is designed for OPEC members, and they're letting Russia run it all when Russia hasn't always held up its end of the bargain. And Russia wants flexibility in terms of production. Honestly, they could just swallow it and be like, look, we know we have got issues, so we're just going to agree to this for the rest of 2019, and our production is probably going to be where it is because we've got this pipeline issue. But Russia being Russia, they're never going to admit to that. And so they want flexibility. Folly said something today that actually looked like it was hinted at greater cuts. I can't imagine they're going to get consensus on that. And then the problem with introducing that into the mix is that then when you agree to just extend or roll over, you get a drop because people were kind of anticipating something more.
Oh, okay, final thing on that before we get to Dr. Foreman. David Blackman had a piece out in Forbes this morning that speculated that if OPEC Plus meets in June or July, and they do not extend the cuts, they actually open the door. It could be the end of the oil and gas shale boom 2.0, if you will. How likely is that to happen?
I think it's one of those things where I think it's like all or nothing. Either they agree to roll it over or it blows up in their face. And I don't want to say it's 50-50 because I'm definitely leaning more towards the rollover extend, but it is definitely a possibility.
And I would say the last thing, but how much does Trump's international tariff policy you think will weigh on them? Because that has to be in the back of the mind of some of the OPEC Plus members, is that if they don't give Trump what he wants, then he might come out with some tariffs on them.
All I can say is that a very conveniently timed tweet from Trump would definitely make that a huge issue. So, you can
count on Trump tweeting during OPEC Plus meeting.
Oh yeah.
Okay, and up next, as always, we have on Dr. Dean Foreman, the chief economist for the American Petroleum Institute. This time they have two reports we're going to go over. One is the normal monthly statistical report, and they also have on their second quarter API industry outlook. Both of these, I'm assuming, Dr. Foreman, will be available on Thursday, and it's good to have you on again, sir.
Thank you. Hi, Ryan. Hi, Ellen. Thanks for having me.
All right, well, let's get into it. Let's start with, I guess, the executive summary. It's kind of where I like to start for the monthly statistical report here. Texas crude oil production, where I'm sitting at right now, exceeding 5 million barrels a day for the first time. Is that good news or bad news for the oil and gas economy right now?
I think it's great news, actually, because it's the fruition of things that we've been talking about and the alleviation of some serious bottlenecks. So infrastructure that's coming, that's really been pent up for a while. It's a really good story for the industry.
One of the things that we looked at this morning on the Texas Oil and Gas podcast was, and I can't remember where the piece came from, but it talked about that that between the Permian and the Balkan, we're currently flaring Israel's, I think it's yearly natural gas demand supply. So whatever Israel needs in natural gas on a yearly basis, we're flaring that. I think is what they were saying between the Permian and the Balkan. And with that being said, our natural gas production is still high. I mean, put that into context for people about how much natural gas the U.S. has, because when you read some of these stories, it's just crazy how much we're flaring, how companies, they don't want to build the pipelines because it's not a lucrative business. Just kind of maybe just from a large picture, what is going on with natural gas? And I'm always blown away on how much natural gas we actually have here in the States.
Well, natural gas and oil, the resource estimates have continued to grow for both. And to put gas in context, when we took stock of this last year, we have 150 years roughly worth of current consumption, exports, all of that. So these numbers continue to grow. So we're looking at a lot more than decades. So we're really looking at 100 to 200 years worth. And the question is, what do you do with all of that? So the cost curve, where you've had industry or others coming out and saying, well, I'm concerned these domestic prices are going to go up. We've seen time and time again over the last couple of years, as we've got record production, record exports, record low prices. Here we are close to a 1-year low now for natural gas in particular, but also oil coming down a bit as the supply continues to grow. Inventories are up, yet exports are at records. So these things, it's not defying gravity. It really is productivity, and it's understanding what's happening in the shale revolution fundamentally in a way that maybe we haven't completely in the past. There were things that were predicted about it a decade ago, but it's really turning out to be hitting on all cylinders.
One of the things that we actually just talked about was that Rick Perry just met with the president of Poland, and they went to visit the Cheniere LNG facility. And I know we talked previously on the podcast about the importance of Chinese long-term contracts from China in terms of really helping the liquefied natural gas industry in the United States. Do you think that it's possible for, say, Poland and other Eastern European countries to kind of take on or shoulder some of that role that people were hoping China might play, or is the demand just not nearly as great in Eastern Europe?
Well, it's a combination of gas-on-gas competition that exists through most of continental Europe, where you've got sources coming from Russia, you've got some from the UK, Groningen and the Netherlands, and then gas coming up from Northern Africa as well. So as LNG comes in from the US or anywhere else, it's competing against all of that. And that's why, compared to Asian gas prices, those in Europe tend to be kind of between the low ones in the US, which are just structurally changed due to the energy revolution, and what you've got in Asia at the highest, usually sitting above $10 per million BTU. And what is really remarkable is how much these have evolved. We've got a snapshot in our quarterly outlook of landed gas prices around the world. And as of May, they're sitting at roughly $5 per million BTU everywhere. And that's, for Asia, that's like half of normal levels. It doesn't mean it'll stay that way, but it's indicative of just how much the supply additions that we see of liquefied natural gas exports from the United States and Australia are impacting that market. And frankly, as that happens, this is going to create or stimulate a lot of demand growth. So it is a good story. And now if the U.S. can convince its Asian trading partners in particular that it's a reliable trading partner and underscore that there is 150 years worth of this stuff, and it's going to be there, and it's continuing to exceed expectations, that's a recipe that then, regardless of whether China enacts certain policies, this will increase liquidity and depth of the market across the globe.
One thing, I was looking at the monthly report here, and you have I know y'all created this new economic indicator, and it says that we've talked about the economy. It seems like every week now. It says it decreased by 0.4 percentage points in May, with a 3-month average of negative 0.1, which suggests a continued slowing in industrial production. So those are numbers, but explain those numbers to me and to the listeners. What do those mean when you're saying you're decreasing? Is this significant decreasing, small decrease? How should we think about those terms?
Great question, Ryan. So the whole purpose of an economic indicator is to have something that is forward-looking, that tells us about where, in this case, it's meant to track with where industrial production for the United States overall, and hence ultimately economic growth, tend to be headed. And what we've been seeing this entire year so far is a slowing trend in terms of industrial activity across the U.S. API's indicator is based on a combination of distillate or diesel fuel demand, the stocks for it, the ratio of that, and how it's been changing. But we also put in some financial indicators and some other industry information to combine it into a composite index. And as we do that, what the 0.4 says, it's meant to track really with the year-over-year change in industrial production, but there's some noise in monthly data. So when you smooth it out over a quarter, a 3-month moving average, you tend to see a really strong correlation with where industrial production ultimately goes up to 3 quarters in advance. And the reason that works is that these fuels and building blocks that go into a lot of industrial activity, freight activity, it really does speak to the pulse of what's happening, perhaps better than many of the other economic indicators that are out there. And we've seen month after month this year where it's just been killing it in terms of predicting the changes in industrial production. That said, when we kind of zoom out and say, well, what's been happening? The current statistics are telling us, if you look at the latest report, for example, from the International Energy Agency, where they've dialed back their estimate of how much oil demand growth there will be this year, a lot of the headlines would suggest that they're really concerned about the global economy and less so actually about the U.S. economy. And based on our information, it's actually kind of the opposite. We see, for example, where domestic oil prices have been led down recently, but the international ones have held relatively strong. The demand internationally, based on the pulse of the exports that we're seeing from the United States, that in terms of our executive summary, if you will, is the key takeaway, that that's actually held up to record levels. So it looks good. But on the demand side in the U.S., we have seen some slowing recently. And the question is how much and how enduring that will be, and whether it's just a blip as, again, you go through these trade frictions and other things that affect our competitiveness and our manufacturing. And the economic indicator then is telling us that on the industrial side, where we see distillates or diesel fuel down as of May 9% year over year, that's a red flag. So we need to then take stock of that and see, well, what's driving it. When we look at freight activity, trucking, and agriculture, actually, the weakest of that appears to be the agriculture sector right now.
That's actually exactly where I wanted to go next. I wanted to kind of interrogate this 9% drop in distillate and diesel demand. So I was wondering if, because you did mention the agriculture sector, the flooding in the Midwest that's prevented farmers from planting a lot of their crops. Are we seeing this play out in this indicator here, and how big of an effect do you think that's going to have on the overall economy, going forward? Because if we're really seeing this have such a big effect in distillate demand, is this due mostly to this weather event, or is it a larger issue?
Fantastic question. Time is going to tell as we see. I suspect it is a major contributing factor to what we're seeing currently. Whether the clouds clear literally and we see this kind of pull out is a different matter. But the trade frictions, in particular of China not buying soybeans, for example, we're seeing reports now of soybean production, corn production. A lot of agricultural commodities are under duress. And this affects, frankly, economic growth throughout the Midwest. So it does have a broader theme that begins with energy, and the energy consumption ends up being a pulse of where the economy might go here.
I've been kind of wondering about this in a while. I mean, if China is not buying soybeans from the United States, then are they either getting their soybeans from somewhere else? Are they growing them themselves? Or are there people just going to starve? Or are they going to eat something else other than soy?
I think it's the latter, that they're substituting foodstuffs of various sorts, and we're seeing it across the Midwest as you go to rural Minnesota and talk to folks about what's happening. There's a lot of crop substitution where, an attempt to try to change off of soy and grow the corn instead. So supply and demand is the way it works.
One of the other things I wanted to highlight in terms of demand was, so you said we've got slipping gasoline and diesel demand, but we've got record jet fuel demand. And so this is kind of almost an anomaly, and this complicates the kind of economic slowdown picture. To me, it says that maybe a lot of this, the weaknesses that we're seeing are actually due to uncertainty involving trade and less of indicators for an economic slowdown, because one of the first things to go is jet travel.
You're exactly right, and that is your strong contemporaneous indicator. And jet fuel, jet transportation as a whole, now it's softer on the freight side than it is on passenger travel. So it does say that consumer behavior, and we see this actually in the University of Michigan's Consumer Sentiment Index, right? The consumers are still at, even though it's come down a little bit, and it's mainly uncertainty around the tariffs that's impacting them, but their jobs, their wages, their growth, they're feeling relatively good. And this is historically relatively strong levels of consumer optimism. So we would expect then, when we look back at what's happening on the industrial side, to say, okay, it's certain industries, especially the ones that are export oriented here, that are getting disproportionately impacted.
Let me just real quick on that, because I noticed the distinction between the travel and the cargo, and I'm kind of backtracking through some of these links here. So help me understand this, because if I think about, like Ellen mentioned, air travel is the first thing go. I'm flying out this weekend for a quick trip, and Ellen flies all over, you fly all over. Well, that's very tangible. We can think about, I'm going to fly somewhere, I'm not going to fly somewhere. But when I think about air freight, I don't know exactly what that means. How do consumers, or do consumers actually know if they are steering away from air cargo demand or lowering air cargo demand by their choices? Because it would seem that theoretically, I could be doing stuff to influence that and not even be aware of it. Does that make sense? I'm not sure exactly how consumers would or wouldn't know whether or not they're changing their patterns, their habits, and then that directly influences the demand. They could be changing their habits and not even realizing, if that makes sense.
No, you're exactly right. And you can think of it as what you order from Amazon that has to be shipped. Mm-hmm. And then, frankly, as the company that makes the thing that's sold on Amazon, what they have to ship through their supply chain. And what I think you're seeing more of is, especially on the trade-sensitive parts of this, more sensitivity to what's actually through the supply chain for various manufacturers.
Okay. So, right. So, I guess my follow-up to that would be is if for instance people aren't ordering on Amazon, but they were ordering for something somewhere else, that demand would still be picked up in other indicators. So it's not because even if you went to buy it from your local store theoretically would have had to have it flown in or something like that as well. Would that be correct?
Presumably, and anytime you base something on statistics, and fundamentally that does underpin the economic indicator that we and others build with API's economic indicator, that structural stability, if you will, of the regime, we've tried to construct it in a way where we used it historically and then held out data looking forward, so that all of the recent years were then calibrated to make sure that, okay, this thing's consistent. And that's why it's performed really strongly since we introduced it last December, is that it really is stable in terms of these relationships, and it doesn't change on a dime because of the way diesel fuel in particular flows through the entire economy.
What do you think is going to be the result of seeing this? Are refineries having lower margins because of this, the diesel, the weakness in diesel demand? And one of the other issues that I can see is, say, the G20 goes really well, and the next thing we know, President Trump and President Xi are best buddies again. The trade wars are resolved, or at least resolved to the extent that a lot of tariffs are lifted. Are we going to see are we going to have a run on diesel fuel? Are we going to have enough diesel fuel? Are refineries producing this and it's sitting in storage? Are we exporting it? Where is it?
So reading the tea leaves and predicting it, especially as we get into prices, is somewhere API can't really go. But what we can speak in the fundamentals to say is that, as this is happening, if anything, the concerns across the energy complex have been whether there's enough diesel fuel as we go into the the regulatory changes that are happening on the marine shipping side at the end of this year. So it's not your everyday headline, but the International Maritime Organization is basically lowering to infinitesimally small amounts the amount of sulfur that will be permitted in marine fuels. This will get rid of the bottom of the barrel, so to speak, or the residual fuel oil that can be burned today as bunker fuel among shipping. And as that happens, and January 1, 2020 is the cutover for doing this globally. And there are debates about how much compliance, but assuming in the U.S. especially that you get really strong compliance, people have been wondering, well, that means a switch to diesel fuel, low sulfur fuels, clean fuels for all of marine shipping that on a global scale amounts to more than 3 million barrels per day. That won't all happen all at once, and we think the market has past precedent where it's going to adjust. But that's why that, coupled with the fact that diesel margins or crack spreads have been more attractive than gasoline for some time, most refiners across the United States have been in the max diesel mode. They've been producing as much diesel as they can, and now you see this softening. So it's going to be an interesting question. Do they switch back to gasoline and make gasoline less expensive? Do you store the diesel? Lots of economic decisions to be made based on what individual capabilities refiners have, whether they have storage or export capabilities, and frankly, what their market views are.
It's an excellent area to watch as as this all unfolds over the next several months.
Most definitely.
Yeah, real quick, sorry to cut you off. I know we're running up against the clock here. Phillips 66 and Plains All American, I believe, announced today or last week that they're going to put in a pretty significant pipeline system that would connect Cushing to Midland, Wichita Falls, Sealy, Beaumont, Houston, and Corpus. I think I got it all in there. We've been talking a long time now about the bottleneck in the Permian, but it feels like now we're getting closer and closer to that. You do have some talk about that and the ducks and what we could, what you're seeing, kind of get us up to speed with where we're at now. We are still, and it does seem, I know you can't make predictions, but I can just say, just from reading the headlines, it does seem that there's still a lot of talk about more pipelines that still need to be built to get everything back in working order, if you will.
Thanks, Ryan. To hit the two kind of major themes that are popping out in our quarterly outlook, the first is this, and we led with this, the alleviation of some of these infrastructure bottlenecks. So the Permian Basin, we've been talking about for some time, the wide price differential between domestic and international oil prices being underpinned by the fact that you've got bottlenecks, that you can only get so much oil and natural gas out of the region. Well, by the end of this year, and this is stuff that's it's permitted, it's being built, it's baked in, you're going to see roughly 1.5 million barrels per day of new oil pipeline capacity egress out of the Permian Basin, and roughly 5 billion cubic feet per day of new egress for natural gas just by the end of this year. And there could, in terms of the project slate, P66 and others going out to 2020, 2021, 2022, a lot more potentially. So it's happening. We've had this call to urgency for year to 2 years of saying we need more infrastructure. This stuff's degrading value. It's affecting the opportunity set for Texas and other places. And as that's growing, we're finally actually kind of seeing the bottlenecks move downstream now toward export infrastructure and markets. And whether it's for the permitting and construction of now liquefied natural gas facilities on one hand, or we've got some content highlighting the urgency to expand our crude oil exports as the United States, which in a month or two ago, we addressed some of this in the podcast discussion. But the evolving view on this is that here we are as of May producing 12.2 million barrels per day of crude oil and exporting about 3. And the U.S. overall total export capacity for crude oil is estimated to be between 4 and 5 million barrels per day. So here we are sitting at 3. There's growth of potential of 1 before you're hitting the lower bound of what you think could be the ceiling for exports of crude oil. And by EIA estimates, the production should grow from the 12.2 where we are currently up toward 13 by December. If that happens and you're largely saturated as the market in the United States, if this is all export-oriented growth, new incremental production and growth, that means that we should be pushing that lower bound of crude oil exports. And these aren't overnight projects. If you're going to dredge a canal, and the reason there's uncertainty over that capacity estimate depends on market conditions and how congested ship channels are and what kinds of ships they are and whether tugboats are available to help lighten or offload or load ships. Those sorts of things mean that we need to start working really now to make sure that there's not a bottleneck there at the end that can back up all the way through the value chain in Texas and other places.
We discussed earlier on the podcast about a Department of Energy official saying that oil prices would now be at $140 a barrel were it not for U.S. production. What are your thoughts on this?
We've had discussions actually up to the White House level about that very topic. And, the analog is pretty simple to construct if you go back to even 2014, where we were averaging close to $100 a barrel for the whole year. If you just look at the amount of production additions and then what's happened with net changes, it's really not a leap to say definitely you'd be hitting triple digits in terms of if you just took the shale revolution away. I mean, without a doubt, because we were there before it happened. And then as we've seen this almost unexpected acceleration since 2015, you'd have to get into how much do people really think Iranian production's taken off market and for how long and what's it really doing. But if you start talking 1 or more million barrels per day on an enduring basis, that does shock the market. And it's not a leap to say that it could get to those kinds of levels, even though you can't micrometer exactly what it is.
That's really interesting because I was trying to go back in my head to figure out how likely this was, and I just gave myself a headache. So it's interesting to hear that, yes, that kind of simulation almost was run by people who can do that. So that's very interesting.
Okay, that is, I know we're up against the clock here, so Dr. Foreman, thank you for your time. Again, you can find these reports. There's 2 reports this month. It is the monthly statistical report, which we go over every month, and then, of course, we have the second quarter report. If you go to api.org, at the top right, you'll see Chief Economist. You click there, and you can see all of their reports, including this one and past ones, and news releases and all kinds of other good stuff. Dr. Foreman, is there anything before we get you out of here that we missed or we omitted that you wanted to point the listeners to before this report comes out on this Thursday?
We have a current blog post out, and one of the key topics in the quarterly outlook is about how the energy revolution from a productivity standpoint has really been evolving. And something that was predicted a decade ago, but really hasn't been until now kind of proven, where we've got up to 15 years worth of data on the Barnett and other shale plays, is just how much the production has been flattening. And that compared to the traditional or conventional production that we've seen, where shale or unconventional production tends to decline faster than conventional production on the first 2 to 3 years. After that, this flattening of the amount of production over the long life of a well has tended to solidify as almost a foundational brick underneath U.S. production. And this, in layman's speak, has led to the so-called decline rate or production rate, basically flattening in a way that is increasing the steadiness of U.S. production and, frankly, helping exceed expectations. This is another, in addition to productivity and low costs, this is another really structural thing as to why U.S. Shale production can be expected to last for decades to come.
Is that titled Growing U.S. Energy Revolution Keeps Exceeding Expectations on June 12th? Is that the post?
Excellent. Yes. Thank you.
Okay. We'll make sure Nate links that up in the show notes so the listeners can just click on it right there as well. Dr. Foreman, it is great to have you back on again. I know we should have you back on next month. We have a holiday, July 4th. I don't know if that will mess you guys timing up, but we'll get you on one way or another. Good to have you back on. Thank you for your time, sir. And we'll talk to you next month.
You're very welcome, and thank you so much.
Thank you.
All right, thanks again to Dr. Foreman for coming on the show. It was good to have him on, as always. And we got a little bit more to get into with the quarterly report. And so a lot to get into. And I feel, I don't know how many more times he's going to come on, but I feel assuming he comes on a lot more, that I will eventually understand these economic indicators. Because every time he comes on, I'm like, okay, I can't spell Iran. You got to walk me through this. But it's always good to hear it and kind of be refreshed about that stuff.
Well, I think sometimes economists have their own kind of way that they speak to each other, or maybe they just kind of like connect brain to brain about these things. Like they talk about these numbers and they all instantly understand what each other means, but the rest of us don't. So it's always good to have him walk us through what this actually means, and because otherwise it's just a bunch of numbers.
And he's very good at breaking it down for even the uneducated like myself. Speaking of economists, we can say this. I think officially Nate has gone out and booked Gene Epstein, who is coming on July 29th. So we will get to ask him about the proverbial inverted yield curve. And so we'll get to, he was the one I think who said that the yield curve was what he was tracking or something. Anyways, he can talk smart stuff again here about a month from now. So I say month and a half. Okay. So, Ellen, all right, we're going to wrap it up. Where will you be this week?
This week I'm going to be on investing.com and also on Forbes. And actually on Friday morning, I was on TD Ameritrade Network. So maybe I'll link to that in the show notes because there was a lot of interesting stuff there.
Okay. Texas Oil and Gas Podcast, Oil and Gas Contractors Connect, obviously. Sitting here beside the smartest person in the universe, Dr. Energy, on Energy Week Podcast. And for the DFW listeners, I might go to the Dallas Petroleum Club and participate in the cornhole tournament this Thursday night. So any of our folks that are out there that are members of the Dallas Petroleum Club, let me know. I'll be out there. Ellen, anything else before we get out of here?
I think that's it, but everyone should keep abreast of what's going on in the Gulf because you never know.
That is right. You never know. Okay, well, with that being said, we will talk to you. We're back next week, so we'll talk to you next week.